Josh Blundell from RBS not only is our host tonight, but he's also our expert on listed products. And he's going to pick up on many of the themes that you've heard tonight: diversification, keeping your costs down, and looking at ways in which you can control your investments with perhaps not having to spend every minute of your waking life looking at what they've been doing. So with no further ado, Josh, thank you.
Now I can see we're all starting to slump in our seats a little bit, so I promise I'll keep this brief. But I'm from RBS Listed Products business, and what we do is we create investment products for self-directed private investors that are designed to be very simple, not only to understand, but also to invest in. Now we've heard a lot about exactly what a SIP is, how we can go about getting hold of a SIP, the role of the SIP trustee, and started to look at some investment techniques, but what I think we're missing in the sort of final puzzle piece of the puzzle is really what sort of investment products can we use to really make the most of our SIP. And what I'm specifically going to talk about is how listed products can be used within a SIP. Now, as way of sort of summary, I think one thing that I sort of take is that the pension fund landscape generally is quite often quite obscure. So a lot of us will be paying monthly contributions into our company pension scheme. We send the money off, don't really know where it goes, not sure who's investing it, what they're investing it in, or even really if it's still there. If we're lucky, we might get an annual statement, but all that really seeks to do is sort of raise more questions than it answers. And on top of that, we have the added issue that we're completely unsure of the sort of costs that we're being subjected to. Now, Jonathan's alluded to this, and this is just a very sort of simple example that I've used to illustrate this. We've assumed £10,000 investment, annual return of around 7%, which is pretty standard. But what we see is that as we increase costs, as a result of that compounding that we've heard about tonight already, our returns are significantly impacted. So if we look at the sort of 2.5% annual fee level, which is by no means large or outlandish for a fund manager, or particularly a fund of fund manager, we see that the returns over a 30-year period are actually half. So costs really do matter. But it very much feels like this whole process has been taken out of our hands by some higher power who, as we see here, if they're investing in other fund managers, investing in fund of fund managers, are perhaps not always acting in our best interests. So a SIP is all about trying to take control. That's exactly what it allows us to do. But what we find is that actually in practice, that control brings with it some issues, because it's not always easy to create that portfolio, deciding which shares to invest in, which funds might want to invest in. How can we possibly create the level of diversification? How can we create the investment strategies that we're paying our fund managers so much to take care of? Isn't this their bread and butter, and shouldn't we be leaving it to the fund managers to deal with? Well, no, actually not anymore. You don't need to do that. Through listed products, through listed investment products, we can provide you simple access to lots of different markets, lots of different asset classes that allow you to create the diversification that Jonathan has stressed. But we can also do that in a really cost-efficient way and provide you lots of different product types, or you might like to think of them as investment strategies, to meet the very different needs that we all have, not just at different stages in our lives, but with different areas of our portfolio. And this is also true of our SIP portfolio. Now, there's really three core requirements that I believe our investments really need to meet, and a listed product is designed to try and meet these three requirements. Now, the first is simple access. Jonathan has stressed the importance of diversification. So what that means is that we need simple access to lots of different markets, lots of different asset classes, so we can spread our risk throughout these range of investments. On top of that, we need investments that I've termed here that are adaptable. And what I'm really trying to say is that we need different types of products to meet our different needs depending on where we are in our lives, what we're trying to achieve, and what area of our portfolio we're looking at. And finally, we need to keep costs down. As we've seen, costs really do matter, and the more they rise, the more significantly that can impact your returns. Now, like I said, listed products are all about trying to meet these three goals. So I'm going to look at these in a little more detail. Now, first of all, as we've heard from Jonathan, diversification is absolutely key in a long-term portfolio. As we've seen over the last couple of years, it's not really suitable anymore to have most of your exposure just in UK shares, because that overexposure to one market, one asset class, can prove really damaging to your portfolio. But what we find is that it's actually very difficult to try and create that diversification. So you might traditionally have looked at doing it through lots of different shares in lots of different companies across the globe. But obviously, we often don't have access to the exchanges that these foreign companies are listed on. We don't have the required resources to do the research into these companies to find out which companies we want to invest in. And also, in order to try and diversify, to try and create a suitably diverse portfolio, we're going to get hit by pretty significant trading costs. So buying lots of different shares in lots of different companies in lots of different countries probably isn't the way to go. So the way that a lot of us turn to is a fund manager. And that's great because we do have the advantage then of the fund manager's skills in picking those companies, picking those particular regions that we should be investing in. But as we've also seen, the problem with the fund manager is that we pay for that expertise, often 2-3% per year. And on top of that, we find that these fund managers tend to underperform their benchmarks. Now, if we're paying them 2 or 3% a year, what we really need is for them to outperform the market generally. And if they're not doing that, again, this sort of option isn't going to be particularly viable for most of us. Now, what we can do through a listed product, though, is because we're a global investment bank, we can actually bring you access to the markets, the asset classes that you once could only get, really, if you invested through a fund manager. So rather than investing in individual shares, what we'll do is provide products that allow you to effectively invest in different market indices, different asset classes generally. So rather than investing in particular UK shares, you'll invest in the FTSE 100 index, so which is a benchmark of the top 100 UK companies. You'll invest in indices that represent shares in the US, shares in Europe, indices that represent shares in emerging market countries, so the Brazils, the Indias, the Chinas, the Russias. We'll also provide you products that invest in commodities, which are notoriously difficult for private investors to get access to. So from agricultural commodities to metals. And we can do that within a very simple and cost-efficient platform. Now, the second point is that we need these products to be adaptable. So we're all at different stages. We all have different requirements from our investments, whether we're trying to secure our wealth and potentially just keep it ticking over, whether we're looking for that long-term growth, or maybe we're looking for sort of medium-term boosts. There'll be different product types that are going to be needed, or you might like to think of them as different investment strategies to try and achieve these different goals. Now, on the one hand, we might be looking to simply secure our wealth and maintain a regular income. So we might see this perhaps as a core sort of foundation to our portfolio. And the way we can do that, one option, is through listed bonds. Now, listed bonds work just the same way as any other bond in that they're designed to pay you an annual return plus your capital at maturity. Now, the advantage with a listed bond, as opposed to any other kind of bond, is that you can do that through your stockbroker in just the same way that you invest in a share. So you simply go to your stockbroker, tell them the code of the particular bond you're interested in, and then you can buy that bond from as little as £100. So you no longer have to put really chunky sums to invest in these products, which enables you to improve that diversification. Now, you might be interested in just a really simple, straightforward bond that just pays you a fixed return each year, and those are available. But there are also those of us that are worried about what's going to happen with interest rates, what's going to happen with inflation. So we also have a range of listed bonds that are linked to interest rates, linked to inflation. So you get a minimum fixed return, but then if interest rates rise or if inflation rises, so too will your return through that bond. So that covers the sort of security, the wealth sort of preservation aspect of our portfolio. And that's perhaps going to be at the core of something like a SIPP, where the ultimate aim is to have a decent pot of money when we retire. But also, in order to really enhance the growth of that pot, we need to invest in long-term growth-bringing investments. And the way we typically do that will be something through like an index tracker, such as an exchange-traded fund. Now, what these can do is effectively replicate the performance of a particular asset class, a particular market, so UK shares, US shares, European shares, shares from emerging markets, commodities, so that we can get long-term access to the performance of these markets. And we're obviously trying to take advantage of the idea that generally and historically, markets tend to trend upwards. Now, the great advantage that we have over something like an ETF or a tracker, which is, as we've mentioned already, a passively managed investment product, is that, yes, it replicates the market, so you're going to get the performance of the market subject to the annual management fees, but those annual management fees are significantly lower than what we might find through an actively managed fund. So whereas we're not getting that fund manager picking our investments, we are getting it at a much lower cost. So whereas you might be paying 2-3% for an active fund manager, typically an ETF or an index tracker will be less than 1%. And as we've seen, as you compound those returns, that really starts to impact your long-term growth. So on top of the security, the wealth preservation element, on top of the capital growth element, there's also going to be times when we're looking to try and achieve shorter-term returns to potentially boost the profits that we make in our portfolio. So we have a third sort of product range, which David's mentioned, are structured investments. Now, structured investments are designed more specifically to be focused on a specific market view. So again, they'll be linked to a whole range of different markets and asset classes. So you can take a view on developed market shares, you can take a view on emerging market shares, on commodities, but their payout and the way they work will be designed for very specific views. So you might think that the markets are going to grow, but not very much. So we have listed products that enable you to enhance the returns so you can make the most of any of that growth. You might think that actually markets are going to stay reasonably flat over the next few years, and we have listed products that provide you really impressive fixed returns for markets doing absolutely nothing at all. And at the other end of the scale, we've also got products to meet the need of those people who actually think the markets are going to fall. We've also got listed products designed specifically to profit in falling markets. So we start to see that we've got a range of solutions depending on your market view and depending on your objectives, whether it's trying to secure wealth or trying to make medium-term gains based on a particular market view you have. And all of these are going to be applicable to you as you invest in your SIP over the long term. But obviously, as with any investment products, there are risks that we need to consider. Now, the first is obviously that with any sort of listed investment product, you're going to be subject to what's called the credit risk of the issuing financial institution or the issuing bank. Now, in our case, that's RBS, and what that really means is that if RBS gets into trouble to the point where it's actually unable to pay its debts anymore, well, in that situation, there's the possibility that you could lose your investment. Now, obviously, this is a very highly unlikely scenario, but it's something that we all need to think about, so it's important for you when you're looking at something like a listed product to get comfortable with the counterparty that you're effectively dealing with. So in our case, that's going to be RBS. Now, on top of that, we've talked about the need for diversification. We've talked about how key it is. What that leads us to is to talk about investments in emerging markets, investments in commodities. Now, these are great because they tend not to move in line with our developed market share, so they're great at creating that sort of diversification. But obviously, these markets do tend to be more volatile. So although that means they've got the potential to make more significant returns, they also come with a higher level of risk. So again, that's something you need to be comfortable with. And finally, the other one you need to think about is if there's any currency exposure that you're going to take in these products. So if we're looking at more interesting asset classes, even if we're looking at gold, as Jonathan mentioned, gold is priced in US dollars, but we'll often want to invest in these products in British pounds. Now, you've obviously taken an exchange rate risk there of the pound against the dollar. Now, some listed products that we offer can actually remove that exchange rate risk, but that's not always the case. So again, you need to be comfortable with the level of risk you're taking and any sort of currency exposure that you might have. Now, with all of our listed products, we create a product fact sheet which goes into all the details of how the products work, as well as all the risks that are involved. So it's just a case of going on the website, trying to find the products that you're interested in, and then reading the fact sheets to get yourself familiar with exactly the sorts of exposure you'll be taking through a particular product. Now, the final point that I want to sort of stress is that of cost efficiency. Now, as we've seen, that costs really do matter. And the great advantage of a listed product is that it is designed specifically to be highly cost efficient. Now, with any investment, you've got two main sources of fees, or with any listed investment. So that is your brokerage fee, which is basically the cost to buy and sell. So just as like when you buy and sell a share, you'll have to pay a fee to your stockbroker, so in the region of, say, £12 per trade. That's the same for any listed product. And you're also subject to the spread. Now, the spread is simply the difference between the price that you can buy the product at and the price that you can sell the product at. And that exists with a share and also exists with all our listed products. But the great advantage with a lot of the listed products is that they are the only costs involved. Any other costs are built into the product itself. Now, the only exception to that rule is with our exchange-traded funds, our index trackers. So just like with the actively managed funds, there is an annual management charge. But unlike the actively managed funds, which are charging 2-3%, these are typically below 1%. Which allows you to get really simple and really cost-effective access to this whole range of markets, whole range of asset classes. Now, this slide's up just to give you a sort of indication of the sorts of products that we've issued, the products that we've issued recently. So we've got issued a selection of ETFs recently linked to commodities, linked to emerging markets. We've got ETFs on Asia, on the BRIC countries, which allow you to spread your risk to create that diversification. And then from there, we've got some examples of our structured investments. So we have our autocall products, which are designed to pay fixed returns for the market staying flat. So our UK autocall, for example, will pay a return of equivalent of 12.3% per year just for the FTSE doing nothing. And then we have our accelerated trackers, which are those products that are designed to enhance your returns. So they'll pay a multiple of the rise in the asset class. So you might have an accelerated tracker that rather than rising by 1%, as the underlying asset rises by 1%, it will actually give you double the performance of that asset class. And on top of that, we've got an element of capital protection in a lot of these listed products. So autocalls, accelerated trackers, they'll often have an element of what's called soft capital protection. And what that means is that as long as the underlying asset, so in the case of the UK autocall, which is the FTSE 100, as long as that doesn't fall by over half during the life of the product, you get your money back. If it falls by more than half, capital then becomes at risk. But it has that element of capital protection for those of us who are worried about the potential short-term downside movements. Now that's great, and we've got a lot of options in terms of the markets we can now invest in, the asset classes we can invest in, the different investment strategies we can get hold of, but that raises the difficulty of actually how do we go about choosing a product or an asset class. And our website, which is rbs.co.uk/markets, is all about trying to bring you access to the markets and help you form that view and decide on the product that you might be interested in. So we publish a wealth of information from expert views. We put out weekly e-newsletters. We put on lots of seminars, just like tonight, where we look at particular markets to help you decide whether a particular market you think is going to be a good opportunity over the next few years. We then have lots of product information which goes into the details of all our different products, designed specifically to help you understand how these different products work, because some of them have interesting payout profiles that you might be unfamiliar with. And then when it comes to actually buying a listed product, as I've mentioned, it's just as simple as buying a share. So you go on our website, find the help, which you can then use to help you form your view, decide the product that you want. You then use our simple product search tool to actually find the product. With that product will come a specific product code that's individual to that particular product, and all you have to do is then quote that code to your stockbroker, and they'll be able to purchase that product on your behalf from as little as £100 in most instances. So we start to see that we can get access to the whole range of asset classes, from developed markets to emerging markets to commodities, very cost effectively, and through a range of different investment strategies designed specifically to meet your particular goals and what you're trying to achieve from your portfolio at the time, all of which is going to be highly relevant to the lots of different decisions you're going to make over the life of your SIPP. So that's about it from me. Thank you all very much for coming down. I hope it's been useful, and I think I'm going to hand back to Dave now for the questions and answers. So thank you.